I'm excited to bring you today's video because it's all about saving money. Let's look at the flat rate scheme for VAT. Okay, the flat rate scheme for VAT we know is an optional scheme. Why would you join it? Clearly you would join it if you want to simplify your accounting, but there is another reason you might save money on the flat rate scheme. Now you need to be able to determine if that's the case by estimating figures what you expect to happen in your business in the coming year. In this video I'm going to show you my flat rate scheme VAT calculator which does just that. It's a Google worksheet and I'll tell you how you can get access to it in the description below. But if you complete this worksheet with the estimates for your business, you'll be able to see which scheme is the best one for you to join. Okay, we're not heading to Xero today. Let's head to Google Sheets and take a look at my flat rate scheme calculator. Okay, let's look at how we're going to work out if the flat rate scheme is beneficial, makes sense for your business. In other words, are you going to maybe make some money or at least not lose out if you opt for the flat rate scheme? So I've created a calculator to work this out and I've done it in Google Sheets and we're going to take a look at it and I'm going to talk you through it. There are two examples on the sheet and the calculator needs estimates, the best estimates, what you think your business will do in a year. In this case, what we're going to do is we're going to look at two different businesses. We've got two friends, we've got Colin and Chris, and they have just finished their computer studies. They're both going to be setting up in business and they're sitting down together and they're talking about whether they should join the flat rate scheme for VAT. Colin is going to be a computer consultant and Chris is going to do computer repairs. So they've both got the calculator, they're going to use the same one, and the first sheet we need to look at on the calculator is where all the workings will be, the estimates for the business. Now this is important on the sheet. I've said to read the notes down at the bottom before completing, but what information do we need to go on this sheet? So we've got example 1. This is Colin and we've looked at the HMRC list of rates and we can see that for computer consultancy the rate is 14.5%. For Chris, we can see from the HMRC list that the rate for computer repairs is 10.5%. I've added these rates in the Google worksheet so you could actually go and refer to them now. They're done today, so it's February 2021, but you want to make sure that what you're looking at is from up-to-date figures, and I've actually added a link that will take you to HMRC to see the up-to-date list. So we're on the HMRC website and if we scroll down, this is where we got our information. So we've got computer and IT consultancy or data processing. This is Colin and that's the rate 14.5%. Then we've got computer repair services and this is Chris and the rate for his business is 10.5%. So we're going to go back into the Google worksheet and we're going to think about the figures that we need before we can get the answer. The answer to the question on the calculator is the flat rate scheme, the right choice for your business. So what information do we need? First of all, we're going to need the turnover, the estimated turnover for the year. Obviously we need to be eligible to join the scheme, so that turnover exclusive before VAT must not be more than £150,000. So we're going to need that information. Then we need to look at the purchases of relevant goods because we need to determine if the business is going to be what's called, in what we've already spoken about, a limited cost business. If the relevant costs are either less than £1,000 in the year or less than 2% of the turnover including VAT, the business will be classed as a limited cost business and you'll just skip the HMRC list of rates and you'll go straight to the highest rate, which is 16.5%. Then the third thing we're going to look at on the worksheet is we're going to look at the costs for the business that include VAT. In other words, if you are going to be on the standard scheme, how much VAT do you estimate that you'll be reclaiming in a year? So we're going to forget about any costs that don't include VAT. We're not interested in these costs for this exercise. And then the fourth thing we're going to look at is we're going to look at capital expenditure. You reclaim VAT on your ongoing costs in your business, but you can also reclaim VAT if you purchase any capital items, any items that are going to stay in your business for longer than a year. So we're going to estimate what they're going to be as well. And also, when we're looking at capital expenditure, we need to consider if there will be any individual items that we will purchase that the value will be £2,000 or over, including VAT. And the reason we're looking at this is because there's one exception on the flat rate scheme. On the flat rate scheme, you don't reclaim any VAT, you simply pay a percentage based on your turnover, except for this one thing. It's if you purchase an individual item that costs more than £2,000 including VAT, even on the flat rate scheme, you'll still be able to reclaim that VAT. So let's fill in the worksheet for Colin and Chris. So example 1, we're going to say Colin Computer Consultancy, and example 2 we will say Chris Computer Repairs. Now this probably wouldn't happen in real life. It's probably unusual that two people will sit down together and do it, but I think it's good for us to look at two different businesses. So we're going to say, what do they expect their turnover to be in the first year? So they've both just qualified, they've both finished studying, they're setting up together, and they're both quite ambitious, and they actually expect that they will earn £100,000, and the two of them expect that. Now I've already read the notes on the sheet, so I know what I need to do. Any figures that I input are going to be in blue. If a figure's not in blue, it's going to be a calculation. So I don't need to calculate the VAT. The worksheet is going to do that for me. So we filled in the value of the turnover. Then we're going to look at the items that are classed as relevant goods. And for these businesses, there's only three things. There's any items that they purchase and resale, any office supplies, and any heat and light, gas and electricity being on the list, and we can refer to the full list on HMRC of what's classed as relevant goods. So I'm going to fill in the figures for Colin and for Chris. Now Colin as a consultant is not actually going to be buying items for resale, but he's going to have office supplies in the year, and he's going to have heat and light. Chris is a little bit different. He is going to be buying items that he's going to buy and resell, and he's expected to spend £10,000 on that. Their costs are similar for office supplies, so £1,000, the same as Colin, and £800, same as Colin again for heat and light. We can see there's quite a difference. Here's the figure, and it's highlighted because it's going to go onto the other sheet to do the calculations. Here's the value of relevant goods, so it's 2,160 for Colin, but 14,160 for Chris. Now we're looking at costs that we would be reclaiming VAT if we were on the standard scheme. So we've got our accountant charging us £100 a month, so £1,200 for each of them for their accountancy. Marketing, we're going to have £500 for Colin. Chris doesn't think he's going to need to spend that much, so he's only going to have £200 in the year. Software, Colin is estimating he's going to spend £500. Chris, in his line of work with repairs, he thinks he's going to spend a bit more, and he's estimating that he's going to spend £1,300. And then we've got telephone. They've both got similar costs for telephone. We're estimating £500 a year for each of them. If you need to insert new lines, you can do it, and you would do it above this blank line here. But that's all that we're going to input for Colin and for Chris. And then we come to the fourth category. What do we think capital expenditure will be? So these guys again have got a good idea what they think at least is going to happen in their business in their first year of trading. So Colin's had a think about his capital expenditure, and he thinks he's going to buy one item at £1,800. Now that is relevant because the £2,000 value includes the VAT. So as long as the figure including the VAT is over 2,000, that's classed as an individual high value item of capital expenditure. Then we get to Chris, and he's going to spend a little bit more. So he expects to spend £4,000. Now it might be two different items, it might just be one, but it's high value items where the item's individual value is over the £2,000. Then they've got some other small items of expenditure. Now Colin's actually going to spend £3,000 here. That could be quite a few different items, but because none of them individually are over the 2,000, they go in the others line. And again, Chris is expected to spend more than Colin here, and it's going to be £15,000 for the year. So the boxes that are highlighted, the figures are going to be pulled through into the calculator, and we'll head to the calculator and take a look at that in a minute. But firstly, just to look at what we've got to the bottom of our sheet. So the bottom of our sheet, we've got what we would expect to go through our VAT returns in the first year of trading. So for both businesses, we would expect the output VAT on their sales to be the same figure, £20,000. Then the input VAT, the VAT that these businesses would be able to reclaim, are quite a bit different. Colin doesn't have as many expenses, so he expects that he'll reclaim 1,860 in the first year, and whereas Chris is expecting a higher figure of 6,800. So the cell that's highlighted in pink is the VAT that we expect these guys to pay for the year. Just out of interest, I've calculated what the percentage of that is based on their turnover to see if it's anything similar to what the HMRC rate is for their type of business. The notes that you want to read before you fill anything in are down at the bottom. A lot of the cells are protected, so you shouldn't need to worry. For example, you're not going to be able to go in here and mess up a figure. It's going to tell you you shouldn't be doing that, so you would just select cancel and get back out of it. If you make any mistakes, the undo button is always your friend. So that is the sheet filled in for both Colin and for Chris. Now we're going to head into the calculator and we're going to see if we think the flat rate scheme will work for them. Now on the calculator, there's actually very little that we need to input. There's a drop down where we select the percentage, and we know that Colin's percentage is 14.5. And we know from the drop down that Chris's percentage is lower, it's 10.5. Chris's percentage is lower because you would expect that somebody in the repair business is buying more and therefore reclaiming more VAT. Then the second drop down that you need to select is whether it's their first year of registration. Well, we know for both of these guys it is. They're just about to set up their businesses. So we choose either yes or no. In this instance, we're choosing yes. Now the figures, anything that's highlighted in a coloured cell, and if it says from estimates, it's been pulled through from your working sheet. If you didn't have that working sheet, or if you just scribbled stuff on a piece of paper, you could overwrite these figures with the figures that you have. But we know their turnover is £100,000. Then we need to determine whether they're a limited cost business. So the first calculation, you don't need to do anything, the sheet does it for you, says what's 2% of the turnover for these guys. So it's turnover including VAT, so 2% of 120,000 for each of them is £2,400. Then we need to look at what is the estimate of the relevant goods during the year. And then based on the answers to these questions, the worksheet will tell us whether we use the limited cost for their business or not. It's in red if it's a yes, because it's just a little bit of warning saying you have to ignore this rate. We've now got to go to the higher rate. So let's just talk what's happened here. So first of all, we've got Colin. 2% of his turnover is 2,400 and his estimated relevant goods are 2,160. So the reason that he's a limited cost business, his value is over £1,000, but the amount he estimates he will spend on relevant goods is less than 2% of his turnover. That's why he is going to be a limited cost business. Now compare that with Chris, where it's a totally different scenario. We're looking to see if his costs are over 2% of his turnover, which is the same figure, or over £1,000. And clearly, in Chris's case, they are, because he is estimating that he's going to spend £14,160. So he is not going to be a limited cost business. So then we come to the line that tells us the rate that we're going to use. Again, this is calculated for you, so there's nothing that we need to do, but we can talk about it. So let's look at Colin first of all. The percentage for his business is 14.5%, but because he's a low cost business, that takes it up to 16.5%. And then, because he's in his first year of registration, he gets a 1% discount, so the rate for Colin is 15.5%. Okay, so let's look at Chris's percentage. For his business, it's 10.5%. He's not a limited cost business, so we stick with the 10.5%, but because he's in his first year of trading, that gets reduced to 9.5%. So now we know the percentage that we need to use. Then, before we can do a comparison, we need to think about the VAT that these guys would expect to reclaim if they're on the standard scheme. And we've already done that in the worksheet, and this is just pulling through the figures. So we expect that Colin will reclaim 1860 and Chris will be reclaiming a higher figure. We've also looked at the high value capital expenditure and the VAT on that. We expect that Colin would be reclaiming 360 and Chris 800. These figures are relevant because even on the flat rate scheme, they'll still be able to reclaim these amounts. And then we get to finding the answer to our question, if we remember, is the flat rate scheme the right choice for your business? So let's look at the final figures, which is what we expect the total amount of VAT to be for these guys, depending on which scheme they're on. So we'll look at the standard scheme first of all, and we've pulled that through again from the worksheet with the estimates. These are the amounts we expect Colin and Chris to have to pay over to HMRC for the first year of trading. Colin we expect to pay more, 18,140, and Chris we expect to pay less, 13,200, his figure being less because he's got more purchases. Then we're doing a comparison. We've now worked out in the spreadsheet, and again the spreadsheet does it for us, how much VAT will these guys pay on the flat rate scheme. And I will just quickly talk you through what it's doing. So it says, okay, here's your turnover, it's 100,000 for the year, but we need to multiply that up to the gross figure, so we need to say it's 120,000. And then the VAT you're going to pay is 120,000 multiplied by this percentage. You get whatever that is, but on the flat rate scheme you'll still be able to reclaim this amount of VAT, so we will then deduct that figure. And when we do that, so for Colin, the VAT that he would pay on the flat rate scheme is 18,240, and for Chris it's 10,600. So what does that tell us? That tells us that if Colin goes in the flat rate scheme, he will actually lose out by £100, whereas if Chris goes on the flat rate scheme, he will benefit. Positive value here, meaning that you will benefit from using the flat rate scheme. So the recommendation on the calculator is that Colin would choose the standard scheme and Chris would choose the flat rate scheme. Now that's not necessarily a definitive answer, because Colin might say, but actually I think the flat rate scheme will be easier for me. We know that it's less work, so I'm going to go with the flat rate scheme anyway. So what we could also do on here is just make one change and say, okay, that's the first year in your business. What if the figures are the same on the second year? So for both these guys, we're just changing to no longer be the first year of their VAT registration, and we're going to scroll down and see what the difference is. So now the difference is more significant for Colin, and that makes sense because the flat rate scheme percentage has gone up. So he is definitely better on the standard scheme now because he would lose out even more being in the flat rate scheme. And then when it comes to Chris, the benefit of him being in the flat rate scheme is still there, but it has been reduced. So it's £1,400 in year 2. If we go back to year 1 was 2,600. there's no surprise that the difference is £1,200, which is 1% of the turnover in the year once VAT is added to it. Now I know this is a bit geeky, there's quite a lot in there, but I think for anybody to use it, it's not actually that difficult to fill in the spreadsheet with the figures that are in blue and then just head to the calculator, select the flat rate scheme for your business, select whether it's first or second year of VAT registration, head down to the bottom. Yes, by all means look at the figures and make sure that they're right, but head down to the bottom knowing that the calculator is doing the work for you, telling you based on values only which scheme is recommended. And that is the flat rate VAT scheme calculator. And don't forget to check out my 2 further videos on the flat rate scheme. 1, the flat rate scheme explained, and 2, how the flat rate scheme works in Xero. If you like the video, please let me know that you liked the video. Why don't you subscribe to the channel and you'll get notified when new videos are uploaded on a regular basis. If you've got any questions, any comments, put them below and I'll do my best to respond. But until next time, happy Xeroing!